Hi, it's Damian from the Peak Partnership, and you guessed it, it's time for our federal budget review once again. It's just over 6 months now that the government handed down an interim budget after its election win last May. Which brings us to the first full year budget with Treasurer Jim Chalmers at the helm. As commentators and everyday Australians, we were looking for answers around a raft of issues. The cost of living pressures and inflation, interest rates, which went up again last week, housing availability and affordability, the financial support for vulnerable Australians, particularly through the job seeker payments, help for small and medium-sized businesses, those promised Stage 3 tax cuts, and the defence spending in the wake of the AUKUS agreement. And there was a whole lot more. But like every budget, there are people who feel that they had a win and some that are not so happy with the outcomes. Our role here is not to fuel the fire of debate, but rather present you with the facts about the key budget announcements and how they affect you. So with that, I hope you enjoy our brief video summary of the 2023 federal budget. But before we get into the numbers, just a word of caution via a disclaimer. The information we're going to present here is just general comment only. It obviously doesn't take into account your personal circumstances, and should you wish to act on any of this information, you should really contact your professional advisor here at the Peak Partnership. So what are the talking points? The budget was coined as a no one left behind budget, a true Labor budget, socialism, spreading the income from the rich to the poor, and how they've been able to do that we'll talk a little bit further on. So there's some big budget numbers and where the spend is, the deficit, or is now a surprise surplus, the level of national debt we're going to end up with, the cost of living assistance they're offering, individuals and families, seniors and superannuation, the more vulnerable Australians, and then we've got the business, infrastructure and projects projected. So what are some of the huge numbers in the budget? The cost of living has been a big issue in terms of the political debate for quite a while now. We've had increasing interest rates and also inflationary factors affecting most household budgets along with energy. So there's $14.6 billion worth of cost of living relief aimed and targeted again at the most vulnerable. In addition to that, there's a $5.7 billion in a boost to Medicare reforms, mainly targeted at bulk billing for GPs, and we'll talk a little bit about who can access that and when. And then there's $3 billion for energy bill relief. So again, one of the talking points has always been the increasing cost of electricity particularly, and how that relief is going to help in families and who can get that relief. And it wasn't specifically mentioned in the budget, but it's certainly a big one that's been a talking point around the budget, is a Stage 3 tax cuts, which begin on the 1st of July 2024, which were introduced by the Morrison government, and they're pitched at a $20 billion cost over 4 years. Quite significant. And then the $4.2 billion surplus came out of the blue for most. In the October interim budget, Treasurer Chalmers indicated that we would be in a deficit of almost $50 billion, and they've been able to create a $4 billion surplus from that. And we'll talk a little bit how that was done. An interesting fact out of that is, because of the level of debt that we now have, we have a daily interest bill of $60 million, that is per day, that we're paying down debt. So what's the surplus look like? As I said, in the previous interim budget, that's the light pink line there, projected to be a large deficit, and now they've been able to come up with a $4.2 billion surplus. The turnaround was really based around commodity prices, which has been a terrific way in which the economy's been able to hold up, strong employment, so very little unemployment, so that means revenues in personal hands are increasing. And then, of course, once you make more money, whether it be through wages or increased commodity prices, there's an increased take on the tax revenue side. Welfare payments have been falling due to the strong employment, and there's been a large surge in migration. So quite a number of people have come into the country and spending money as well. So it's a pleasing thing to see, but you can see from there, they're projecting further deficits in the years ahead. Once again, there may have been some conservative balance sheet work there, particularly around the cost of commodity pricing, but only the future will be able to tell. And again, we need to be cognizant of the fact that the next budget will be a pre-election budget, and generally there's a period of time which they're starting to do positive things in terms of handouts. So what's the net debt forecast? So this is our net debt, gross debt less net. Should go out to $574 billion, or 22.3% of our GDP in 2024. And for your information, in 2026, our gross debt, so that's before any of the assets, will hit $1 trillion, $1,000 billion. So we're really in some big numbers these days. So where have they pinched all this money and where are they putting it to? So we've got some cost of living relief. So Medicare, the $3.5 billion to incentivise doctors, GPs, to bulk bill. So this is anticipated to help 11.6 million Australian to access free healthcare. Bulk billing consultations will be limited to children under 16, pensioners and Commonwealth concession holders. So quite a wide-ranging group, and again at the lower level, which will help in terms of their costs and access. There was also the energy price relief plan, where it's expected that there will be an eligible households of 5.5 million residents will get up to $500 rebate, and businesses, small businesses, will get up to a $650 rebate off the bill. Now just note that is a rebate, it's not money coming back to you, and it must remain on the Energex or Atlanta bill until you use that up. And that's going to be particularly targeted again at concession card holders, family carers and recipients. The bill is going to be co-funded by the state, so there will be a slightly difference if you're listening in a different state. In the Northern Territory, the ACT and the WA, that'll only be $350 due to the co-contribution by their state governments. So the cost of living relief is also extended out into some of our more vulnerable people that are on concessions. So the Commonwealth rent assistance is going to be increasing by a maximum of 15%, which is only $31 a fortnight, but it does add up when you've got 1.1 million households, and it comes in at a cost of $2.7 billion over 5 years. And then the first home guarantee. So we've got a situation in the housing market now where there's a definite slowdown in the new applications, and there's still a requirement for more demand for new housing. So this will only spur on additional housing demand. The scheme's going to be expanded to allow for any two eligible individuals beyond married and de facto couples. So brothers and sisters, siblings, friends and family members can buy their first home with a 5% deposit and no mortgage insurance. The scheme will also include non-first home buyers who have not owned a property in Australia in the preceding 10 years. You must be a permanent resident of Australia or an Australian citizen to be eligible. What else do they have up their sleeve? A regional first home guarantee. So very much measures the first home guarantee, but this is expanded in terms of regional areas to get a little bit of distribution. So what do those tax rates look like? They haven't changed. In one of the few things not changing in this year, and you can see there the tax bands continue right up to $180,000 and 45 cents in the tax. And of course those rates are exclusive of the 2% Medicare levy we need to pay. So there is the Lamington, or the low and middle income tax offset, which has been discontinued from the end of 2022. So what that means is that when you come to lodge your 23 tax returns shortly, you may find that you have a lower tax refund or in fact have a tax debt. So just be prepared for that. The low income tax offset has been retained. It's a maximum of $700, but you'd only be on an income of $37,500, and then as a sliding scale, it disappears until you get to $66,668. So what does it look like for individuals and family when the stage 3 tax cuts come in on the 1st of July 2024? You can see there's a compression of the tax rates in the whole 45,000 to 200,000 will be at the 30 cents. What the main band there is in terms of numbers is the people in the $45,000 to $120,000, and that's the main cost of this initiative. So you wouldn't class those as being wealthy people, but they are going to benefit from the drop in those tax rates. In addition, when you're looking at the tax reduction, any of those tax bands go from the 32.5 cents or 45 cents down to 30 cents. There's a fair change. One of the incentives, again, in terms of the recent inquiries with the government, has been around aged care, and our aged care workers will receive a 50% pay rise from the 1st of July 2023, and that'll cost $11.3 billion over 4 years. And it's a well-deserved increase. There's no doubt that they do a wonderful job. Wages for registered nurses and enrolled nurses will increase, so a registered nurse up $10,000 a year and $7,500 for an enrolled nurse. Women in the workforce, again, they're trying to get the participation rates up, $8.6 billion to be invested in boosting the number of females in apprenticeships, traineeships and cadetships, including a specific target for the number of women in those roles. The National Teacher Workforce Action Plan, again an area where there's been a lot of inquiry. We're seeing a lack of teachers, and particularly male teachers in this case. They're now going to invest $9.3 million in addition to the $328 million previously announced to attract, train and retain people in the teaching profession. So what's happening in our other end of the world, in the seniors and superannuation? We had a situation during COVID that they reduced the minimum pensions we had to draw out of our superannuation. This was obviously to assist pensioners to retain capital during what was a very volatile time in the market. And now those pension rates have gone back to their full 100%. So you'll see there, depending on your age, there's a minimum draw between 4 and 14%. The aim there is that the government wishes you to draw all your money out of your superannuation by the end of life, so that there's not left in a tax-free environment. Further news in terms of superannuation, the SGC, as we call it, the Superannuation Guarantee Levy, which is a compulsory contribution by your employer, increases from 10.5% to 11% on the 1st of July 2023. And the superannuation guarantee payments, looking at a bit further, from the 1st of July 2026, will be required to be paid the same day the workers are being paid. So there'll be no time lag, as currently as quarterly payments are required. You'll be paying the superannuation for your employees the same day you pay their wages. There is a proposal, and it was reinforced again in the budget papers, that the wish to tax superannuation balances over $3 million from the 1st of July 2025 at 30%. So currently those earnings over $3 million are either taxed at 15% in accumulation phase, or actually zero when you're in pension phase. There is a little bit of a hair in that proposal, in that currently it requires 30% tax to be applied to both realised and unrealised gains. So what they're saying is that if there's an increase in the market value of your assets, you're going to have to pay tax on that, which we think is inequitable and no doubt will take some scrutiny before it gets through. And then there was $40.2 million given to the ATO, or will be given to the ATO, to identify acts of superannuation guarantee underpayment or non-payment. This comes back to the Labor Party's wage theft issue, where superannuation guarantee is not being paid or held back by employers. So the more vulnerable Australians, how have we been able to help them? The single parent payment, which is currently a fortnightly payment, will increase to $922.10 from September 23, and it was only to cover children up to the age of 8. They're now going to increase that to cover children up to the age of 14. So they indicate that it's going to benefit 57,000 recipients, and obviously in our society most of those single parents are still women. The job seeker, the base rate is increasing by $40 a fortnight from 20th September 23, and it also apply to Austudy and youth allowance. The job seeker recipients aged 55 to 59, the payment will actually increase further to by $92.10 per fortnight, provided they've been on JobKeeper for more than 9 months. This is an indication that they're trying to just transition those people from JobKeeper into the age pension. But no doubt it'll come in handy. The biggest expense item we have in our budget is the NDIS. The NDIS is one of those budgeted plans that had a wonderful idea, but maybe the implementation needs a little bit of work, and that's what they're doing here. They've created the National Disability Insurance Agency, which gets funding, and the funding is to how it works to support and participate, and also then reduce fraud for NDIS payments. So I think that's going to be particularly interesting to see what they can pull back in terms of the expenditure. So what's happening for our business clients, infrastructure and projects? The Instant Asset Write-Off Scheme. We thought this one was done and dusted. They breathed life back into it, and now there's a significant winding back that allows us, when you have an eligible small business, so a turnover of less than $10 million, you can write off up to $20,000 any one asset in that next 23-24 financial year. It previously was up to $150,000 and a $5 billion turnover. So they've turned the screws down on it considerably, and probably part of that is not wishing to alleviate or to accelerate the issues around inflation and pull demand where people are spending money. They've created a small business energy incentive. The business with annual turnover less than $50 million, so that's most of us, will have access to a bonus 20% tax deduction for eligible assets supporting electrification and more efficient energy use. So this starts on the 1st of July 2023 and must be installed and ready for use by the 30th of June 2024. You can include up to $100,000 of total expenditure in electrifying heating and cooling systems, installing batteries and upgrading to high efficiency electrical goods. And then on top of the spend, you'll be eligible for a maximum of another $20,000 deduction. So business cash flow, 2.1 million eligible small businesses will have their quarterly instalments for GST and PAYG instalments reduced. What they've done was a standard increase when you're using the ATO calculated rate has been reduced from a 12% increase to a 6% increase on the prior year. Just be aware, even though they're just paying a smaller amount as you go, you still will need to pay the balance of any tax payable on lodgement of your tax return. And a further issue that came up, the large end of town, this is where we're getting the money from. Large multinationals and companies pay a minimum 15% tax on Australian earnings. That's been one that was being chased by the Morrison government in terms of the large the Googles and Amazons, etc., and making sure they're paying their fair bit here in Australia. The petroleum resources rent tax also went up. Wasn't much of an eyebrow raised by most of that industry, so maybe it could have gone up a little higher, but given now that we've got the natural gas issues and a fair bit of tax to raise, another $2.4 billion coming from that. And a national reconstruction fund to help develop green industries and manufacturing has been funded for up to $15 billion. There's a capacity investment scheme for renewable energy projects, a big green ticket item at $10 billion, and a hydrogen head start program. I'd be very interested to see how this one plays out. We could become quite a leader in that hydrogen production area, and that's targeted for $2 billion. $211.7 million over 2 years for the Thriving Suburbs program to provide merit-based and locally driven grants for priority community infrastructure. So that is quite open-ended, but again, another one of the creating assets while times are good, so I don't mind it. $159 million to support transformative investment in projects in urban Australia through the Urban Precincts and Partnership Program. And $3.4 billion, particularly here in 10 years, to fund the 2032 Brisbane Olympics and Paralympics Games. So there's going to be a fair bit of construction in Brisbane over the next 10 years. So just a quiet mention before we sign off. It is end of financial year coming. It's only 7 weeks away, and we really like to start doing something and helping you do your end of year tax planning and cash flow planning. So make sure that you've gathered your financial records together. Don't leave it too late to get those things together. Be prepared to pay deductible expenses where possible, where they have a less than 12-month life, and where appropriate, offset capital gains you may have got through the sale of some of your stock, etc., against capital losses. But most of all, book in early, make a time to see our experts here at the Peak Partnership, and you can do that online at peakpartnership.com.au/year-end-planning. And don't forget, if you'd like a full summary of the budget with additional details, you can grab your free copy from the webpage again, peakpartnership.com.au/budget-23. And of course, we can't let you go without again promoting to you our mobile app. It's been a wonderful investment and we've got a lot of clients using it and we're particularly happy with it. It's free to use, free to get, and we like to say it's free advice. So if you're going to download it and you haven't got it yet, they will ask you for a code word. That code word is PEAK, P-E-A-K. If you enter that in caps, then you'll be able to download it and work your way through it. Well, there you have it. That's the federal budget for 2023. We hope you got something out of the presentation, but if you have any questions, you can contact us by phone, by our webpage, or even by email at email@peakpartnership.com.au. And of course, you can get a copy of our free budget report via our website on the address shown below. And lastly, just a quick reminder, the end of financial year is not that far away. So if you'd like help with cash flow planning, tax planning, please set aside some time with us for a review meeting well before the 30th of June. Again, just go to our year-end planning webpage to book a time. So thanks for watching.